Good morning, and good morning, guys. You today are in for a treat. Because look here, I went back to get my dude. This is my dude. Every time we see each other, we say, dude. Guys, look, you're in for a fabulous show. Welcome to Exit Strategy Radio Show. Guys, I'm your host, Colin J. Millett, broker and owner of Exit Realty Low Country Group in beautiful North Charleston, South Carolina. As always, guys, we will give you an action-packed, we'll give you a fun episode. And guys, we'll make sure that you got some information that will be useful in the endeavors that you set forth to accomplish. All right? So today, guys, is no different. We have with us Dave Kliewer with Paramount Residential Mortgage Group. Dave, how are you doing today?
I'm doing great. Thanks, Corwin.
So look, I got to hit our normal intro. Dude. So thank you so much for being here with us today. So Dave, if you don't mind, give our listeners a smidgen, if you will, about you. Where are you from? What got you into the mortgage industry? Just tell our folks about you.
I'm originally from Chicago. I went to school in northern Indiana. I came to Charleston, a little over 20 years ago. I can't believe it's been that long. And I had worked in the RV business, recreational vehicles. And I thought, well, I worked in the manufacturing end on that and sales. And I thought, what's a good industry to switch over here in Charleston? And I started selling mobile homes. And I didn't enjoy that because it just wasn't fun for me like recreational vehicles was. Mm. And so what I did is I took the part that I liked from that, which was the financing end, and became a mortgage lender. So I did that pretty quickly after moving here. So
okay. Yeah. Well, I don't think I ever knew that you sold RVs. So that's a whole nother conversation.
Oh yeah.
Have at another time, but I will kind of drop this piece. And I remember I was in the midst of a transaction some years ago. My client was, I think he still is, it was a regional for a for an RV dealership. So he's a regional, what have you, and he in the midst of a transaction, he just kind of said to me one day while we were together, he's like, Corwin, he said, look, he said, this doesn't make sense to me. He said, I can finance approve someone to buy a $500,000 $1 million RV in 96 hours. They drive away with it.
Yeah.
A house, why it take y'all 30 days? He could, I can't understand that. So I may ask you that question, but thank you so much for sharing, a little bit about, your background and your history.
Yeah.
So, you've been in the mortgage industry for roughly about how long now?
About 20 years. Like I said, I made that move pretty quickly after moving here, after being in the mobile home side of it. So
I'm going to ask you, and this is a question that obviously, is par for the season that we're in. And I don't want to harp on it or dwell on it. But as we have been meeting, interviewing, and, discussing, the market in general with, other practitioners, obviously, our lenders and lending partners, things of that nature. And just, we've done it, again, both in meetings. We've also, as we had the opportunity on air to kind of have those conversations. Tell our listeners, what is it that you're relaying or saying to a consumer in this time? Because so many people are really disoriented about the current quote unquote climate. But you've been doing this 20 years, so you've seen.
I've seen this market before.
Yeah, part, but you've seen worse. So go ahead.
So really, what's happening right now is there's a big pricing issue, and a lot of that has to do with what the Fed is doing with rates. But at the same time, there are bonds are going down, and like the T-bill, the Treasury bill, those two things working against each other really puts us lenders in a tight position as far as pricing is concerned. So we're at a point right now where pretty much every lender you go to, you're going to see really high interest rates comparatively, maybe at times 3 to 4 times higher than we were just earlier this year. And then on top of that, going to be points. And the problem is that just to break even, that's what we are having to do, and that's what other lenders are having to do. Now, there have been a number of lenders out there that have taken their money that they've used for that they had earned in the past year or so doing refinances like crazy and just earning tons of money, and they've got this big pot of money to use. They're losing money on every deal just to take up market share and grow that business so that they can grow their name. We had not been doing that, and it's not necessarily illegal, but at this point it is against the rules as far as Fannie Mae and Freddie Mac are concerned. They stomp down on that just so that there's an even playing field. Now, if a lender had their own money and they wanted to do something like that and it wasn't backed by Fannie or Freddie, then that's a different story. They could still do that, but I'm not sure who or if they are doing that. Maybe I'm giving secrets away that I shouldn't be, but
so what I just heard was if it's a direct lender, they're not a bank or they're not writing or selling directly to Fannie. Maybe they have private investors or something of that nature, and those kind of things they can do. Is that the right understanding? Or is it
I'm sure that anybody that has pools of money like that would be Fannie Freddie approved as well, but it would be private pools of money that they would use to do that. But again, that's only a short-term solution because they're losing a lot of money by doing that. And, they can only hemorrhage for so long. So we'll see what happens with that if anybody starts to use that a lot or what happens.
So you touched on something that most consumers, and to be frank about it, most real estate professionals, have a misunderstanding about. There is not a direct correlation between the Fed raising interest rates and lender rates. Lender rates are controlled by the market. That's where it comes from. Pricing, as you said. So
it's more controlled by inflation than
Okay, so inflation really impacts it, is what I just said. Okay,
inflation, and the T-bills, the Treasury bills.
Okay, and inflation.
They have a more direct correlation. Let's put it that way. It's not.
Okay.
You can still have T-bills going down and rates not reacting the same way to that. Say there's another war going on somewhere else that we hadn't known about, and, or somebody gets bombed, or some big issue that happens, and the market reacts definitely towards it. That happens sometimes.
That's real interesting because, inevitably consumers, we believe we can time everything. I mean, it's almost like we believe that we can play double dutch with the real estate market. We can understand. Say you see the little kids.
Yeah.
All right, I'm getting time.
Yeah.
So that's literally what the consumer believes. They can time the market, and in turn, they oftentimes look to their real estate professionals, whether that be their realtor, whether that be their lender or whoever, to quote unquote assist them in timing the market.
Sure.
But the problem with that is, like you said, look, you playing, you jumping rope. That's one thing, but the real estate market, and I've never said this before, Dave, but just envisioning it, it's like double dutch with 13 ropes. and hold on, this is the thing now. It's 13 ropes held by 2 people that got 17 hands. And they rope around. So
You're right. I used to call it a system of levers. So it's the same thing. There's so many things going on. You can't predict what's going to happen, and especially if you're talking about buying a primary residence, don't make your decision on what the market is doing. That's a long-term investment, and eventually you're going to make your money back, and then some. But it's, as far as predicting what is going to happen, once you have a contract the lender is going to sit there and say, all right, next 30 days or however long the contract is written for, what do we think is going to happen with rates? And either they pay attention to that or they pay for products to give them a heads up if things are, going to happen within a few days. I get answers. Usually I'll get a text and a phone call 30 minutes before something happens. And then I can decide to lock somebody in or not. But that's the point where I'm saying to the borrower, listen, this is a really weird market. Let's lock things at where they're at now, even though it's not optimal, because, yeah, sure, rates might go down, but they also might go into the double digits, So let's be conservative on that.
Yeah.
And then if they eventually go back down into the 2s and 3s, then refinance.
So that's the logic speaking, right? So obviously, we don't always work well from logic. Sometimes we are emotional and,
especially buyers with first-time home buyers. And and they should be, because they fall in love with the home. Investors are different, but I understand that.
So the question in that and behind that, and this is the conversation I've been having recently. I said, look, rates at 3% really are abnormal.
God, they've never, only one continuous time they've been at that rate ever.
So when you look at history, and you got 20 years of industry history, but when you go outside of that and look historically, we're still even now in a good rate market. Right?
My parents bought their first house at an 18% rate, and they were just so blown away excited about it.
So one of our partners in a conversation some weeks ago, we're having this conversation, and he shared with me, he said, when I got in the business, you were lucky to get the $12.99 special. And we're having, Lord Dave, we have so much conversation about rates that, and I get it does impact affordability. Yes, it does. I agree with that wholeheartedly.
Yeah.
However, the issue with affordability isn't in the interest rate. It's in the pricing in the market.
Absolutely.
So, and those things are only impacted by supply and demand. So
Correct.
We still have a shortage of inventory, which from my side, we have a shortage of available homes. And in turn, we have a very high demand. So that means that people are still out here signing up for, if they could get the $12.99 special, I'm pretty sure people will still be buying the $12.99 special.
They'll do it, yeah.
Because they want their own home.
You gotta live somewhere, and it's still going to be better than renting. So
exactly. So let's go back and have this part of the conversation. And I do want to make sure that I kind of pick up, because you guys service everybody. You service investors. You service owner occupants and stuff. With the
all over the country, as long as it's
okay.
as long as it's less than 4 units, and then we can, or raw land. But
so let's talk about this. Let me market shifts. There's everybody. It's incredible. When I got into the market, everything was 100% financing, and then it went to 80/20s, and then we had the market downturn, and then every conversation since then. So since about probably around 2000 and maybe 8ish, 9ish or something, I've never done. I've been in the business for 4 or so years, had never closed an FHA mortgage. Didn't close my first FHA mortgage until 2008, 2009 time.
There wasn't any need to.
Exactly.
For the most part.
Now we're in a different market. So what do you think is going to be the product, quote unquote, the go-to product of choice?
Well, it's still going to be conventional.
Okay.
Here, let me put it this way. It's still going to be conventional if your credit scores are decent enough and you have 20% to put down. Even if you have 5% to put down, even if you have 3% to put down, a conventional loan is going to be better than an FHA loan if you can qualify for it. The reason I say that is because your monthly mortgage insurance on your FHA loan is going to be there for life. Never goes away. It used to go away after a few years.
Mm-hmm.
Now it's there forever. Plus, you have an upfront mortgage insurance
Mm-hmm.
fee as well. So if you go with a conventional loan that has mortgage insurance, and like I said, your credit scores are decent enough to go into the conventional market, even if it's a higher rate, you're still going to be saving money in that mortgage insurance. Mortgage insurance on a conventional loan is probably going to be less as well. And then eventually you can apply to have that removed, depending on how long you had the loan and the home, and how long or how what it would appraise for.
And that's an interesting concept and thought process because I'm going to share with you what consumers believe. Consumers believe because real estate professionals have been just out here. I mean, all they say is the same thing. You can buy a house at 3.5% down, 3.5% down, 3.5% down, and that's kind of the tagline. And the 3.5%, which we know is an FHA loan.
Yeah.
3% on conventional. Yes, you may have to have a higher credit score to qualify, slightly higher credit score, possibly to qualify for that program. But your savings over the life of loan is going to be greater than it would be with FHA.
Tens of thousands of dollars less.
And the other thing that you said
in a lot of cases.
So the other thing that you said in there, and this is where people, again, they miss the savings with the mortgage insurance, where you get to a certain place and you can either automatically drops off, or because it doesn't automatically drop off anymore with FHA. But on the other side of it with conventional, if it doesn't, but you have the value, you can challenge the lender with comps or appraisal. Exactly. And get that removed and save yourself without having to refinance the loan.
Correct.
That's where uncertainty comes
Correct.
in. Correct.
Without having to spend more fees to refinance the loan and get that removed. Correct.
So how do you explain this? Because again, most times the real estate agent is pushed this person to you and said, FHA loan, because they don't know and understand what you know and understand. So how do you address that with the consumer, let's say when you get an application?
Hey, it's the easiest thing in the world, because you just tell them, hey, listen, you've got the FHA side, which FHA is there right now for somebody to be able to get into a home. Somebody that is not within the credit score range that they need to be, or maybe their debt to income ratio is a little bit higher and things are a little bit more shaky. They can qualify to purchase a home and maybe eventually refinance out of it and get rid of that mortgage insurance, which is what you would have to do with an FHA loan. So it just makes it available to more of the market. Now, if you can qualify for the conventional loan, by all means, never say never and all that, but I can't think of a situation where a conventional loan would be worse than an FHA loan because of what we've just gone through. On top of that, it's easier and it's quicker to get done. I mean, there's literally a lot less paperwork to do on a conventional loan. So it's more lenient as far as the property is concerned, a little bit more strict as far as income, assets, credit. But like I said, the FHA at this point is there to get that extra market share, not to get that extra market share. It's there for the consumer to be able to purchase a home if they're not quite at the conventional loan status. But I say to the consumer, if at all possible, if you have 3 or 5% to put down, I really stress that 5% because it cuts down on the mortgage insurance so much and it makes it more available as far as credit scores are concerned. It's an extra 2%. And a lot of people, that's hard to do, but it's better every time if you can go conventional.
That is very helpful. That's a conversation oftentimes is not had. Because, people, and I get it. We want to give the bare minimum at times. I was fortunate when I've made my what has been the last purchase I made, not the most recent. I used it on a primary. I used the FHA, and that was prior to the change in the MI. So that MI dropped off. Dropped off. I think it's dropped off. I mean, it should have dropped off, and I need to look at that now that I've said that out loud. But those kind of things happening are differentiators and game changers for the consumer. And I believe it dropped off because I distinctly remember my mortgage going down. As far as the payment or whatever went. So, that is awesome. I'm gonna share this piece, and Dave, if you don't mind, This is probably a great place for you to drop your contact information for our listeners. How can people get in contact with you?
Yeah, sure. You can contact me. The best way is usually by email, DKLIEWER at P as in Paul, R as in Rose, M as in Mary, G as in George, .net.
Okay.
.net. So DKLIEWER at PRMG.net. You can also contact me on my cell phone. You can text me or call me at 843-364-0147.
All
Again,
right.
that's 843-364-0147.
All right. When y'all call him, y'all please, when he answers the phone, say, dude!
Please do. Please do. Yeah. Please do that.
That is hilarious. I get a tickle out of that every time, man. So, for our listeners, guys, the thing that's going to help you all win is having an understanding. Let's operate beyond just the emotional response. Yeah, you don't like this or this, here, that, and the third, but you can't control that. What you can control is you. And the options in this current
and logic.
Exactly. So
Yeah.
and this is where the question is coming right here, Dave, because you hear people, the logic and what we're explaining to people is, look, we still short of inventory, which means pricing is going to continue to increase. I don't think it's going to run away. I don't know. If I had a crystal ball, I'd have hit that billion.
Yeah.
If I had a look here, yeah, right? A lottery, I'd have hit the billion.
You wouldn't have my phone number. Well, you would.
So when I call you, I'll be like, hey, dude. So, that's the thing that people don't get. We're so boxed in our thought process that we don't correlate. If rates ever come down, if you have your position on your home, you can always refinance. But if you don't have your position, you not only got to get your position, you also got to finance it, which means you can end up paying more for the home, even though you may have a slightly lower rate, and you'll end up paying more over the life anyway. Lock it in now, reposition if you get the opportunity. If you don't get the opportunity, then you already got a great rate, right?
And those are details that should really, that the loan officer should really be handling, and those are questions that they should be handling. I think that a lot of times what happens is the realtors end up being the one the buyers call first, and that's kind of backwards as far as the process should go. So when you talk to a realtor, the realtor's going to introduce you to the fact that there's going to be a mortgage and stuff like that, and maybe tell you a couple different type of choices and find out how much you want to put down and stuff like that. Then it's the job of the loan officer to really get into the details and explain why and which loan is best for you. So.
Well, dude, I really appreciate you taking time out of your busy schedule to be here.
Absolutely.
Exit Strategies Radio Show.
Thanks for having me.
You're more than welcome. And thank you again. For our listeners, guys, hey, you have gotten some good, useful information. Please apply it. Please utilize it. Please do something with it other than just hear it. Do something with it. Make the decision that's going to work better and best for you, but make sure you understand all the different facets, all the different components that go into making an informed decision. Knowing what rates are, yeah, but understanding the potential, the possibilities, all those variables and all those things that could impact or change, quote unquote, that future outcome is going to benefit you today. There is no better.
Let us inform you on those different items.
Exactly. And there's no better
time. The realtor and the lender.
There's no better time than now if you're ready.
Correct.
Who knows what tomorrow may bring. So Dave, again, my man, I greatly appreciate your time. Thank you so much. Again, for our listeners, guys, thank y'all for tuning in. As you know how I feel, y'all should know, but I'm going to tell you anyhow. I love you. I love you. I love you. And I'm going to see you guys out there in the streets. Dude.
Dude.